Hello and welcome to the Heart of Economy channel. Here, we try to understand what's really happening at the core of the financial world. Today, we are covering a very critical topic. Before we begin, don't forget to subscribe and turn on the notifications so you don't miss any of our updates. We don't just look at the numbers, we focus on the real dynamics behind them. Today's headline is the US housing market crashing. Meredith Whitney's new mortgage warning. This may not just be about home prices, it could signal a quiet but major shift in the economy. Let's explore the details. Housing crisis or economic shift. Economic data often looks calm on the surface, but real change happens underneath, quietly and constantly. The housing market is one of the clearest signs of this hidden change. Right now in the US, this shift is becoming more visible than ever. We are not just talking about slow home sales or rising mortgage rates. The real issue is that the entire system seems stuck. And the first to raise the alarm is someone with a strong track record, Meredith Whitney. She predicted the 2008 crisis before it happened, and now she is warning again. She says 2025 could be the worst year for housing in decades. This isn't just about real estate. It could trigger a domino effect across the whole economy. It may affect central bank decisions, personal borrowing, spending habits, and more. Even consumer confidence and investor psychology could take a hit. Go deeper than just the data, we'll explore the history, the demographics, and the psychology behind it all. Because in finance, the real story is usually hidden, and we're here to uncover it. This time, we may not be facing a sudden crash, but a slow, long-lasting freeze. A new kind of crisis. Quiet, invisible, but deeply damaging. What is the housing market? More than buying and selling. The housing market isn't just about real estate deals. It's a reflection of a nation's financial health. Buying a home is often a person's biggest financial decision. It's not just about shelter, it's about confidence in the future. When people feel secure, they buy homes. When they don't, they wait. Home sales affect many other sectors: construction, appliances and furniture, banking and loans, insurance, local governments, logistics and moving services. If the housing market moves, the economy moves. If it's stuck, the economy slows down. It's also a social indicator. Who owns homes, who rents, which neighborhoods grow or decline. These all reveal income gaps, social mobility, and development trends. So, housing is about much more than real estate. It's about economy, society, and the future. Now, let's look at 2025. Home sales in the US have dropped to around 4 million per year, one of the lowest numbers in the last 30 years. Homes are sitting on the market longer, buyers aren't buying, sellers aren't selling, and yet prices are not falling. Why? Because people don't want to sell. If they do, they'll face mortgage rates over 7%. That means much higher monthly payments. So they stay put. They are locked in with older, low-rate mortgage. This is a rare event. A double freeze. No buyers, no sellers, no loan applications, no new credit, high rates, low demand, and psychological barriers keeping people from making moves. This is a structural freeze, a loop that feeds itself and gets harder to break. It's not just an issue of housing, it's a signal of deeper economic trouble. If homes don't sell, money doesn't move. If money doesn't move, businesses hold back. If businesses hold back, growth stops. This freeze could ripple across the economy. And remember, crises don't always start with noise. Sometimes they come silently, but their impact lasts for years. The 2008 financial crisis was caused by excessive risk taking and ignoring those risks. At that time, financial institutions handed out high-risk loans, subprime mortgages to low-income borrowers. These were packaged, securitized, and sold around the world based on the assumption that home prices will keep rising. But when that assumption failed, the system collapsed. People couldn't repay loans. They lost their homes, bank failed, and the global economy was shaking. Today's situation is completely different. In 2025, the problem isn't people failing to pay their debts. It's that they are not even willing to take on new debt. This time, the crisis isn't coming from inside the system, but from the outside. As Meredith Whitney points out, the issue now is lack of demand. No one wants a mortgage. High interest rates and a lack of confidence in the future are keeping people from borrowing. This is a key difference. Economies run on two things: liquidity and expectations. In 2008, there was liquidity, but risks were mispriced. Now, risks are managed better, but expectations are broken. People have lost long-term trust in inflation, interest rates, and housing. This affects not just real estate, but the whole economic cycle. In 2008, the problem was bad loans that couldn't be repaid. Today, it's that no loans are even being requested. Credit isn't being blocked, it's being ignored. Without activity, there is no growth. That's why today's crisis is quieter, but possibly deeper. Back then, governments injected money into the system and restarted the engine. Today, giving out money isn't enough because people don't want to spend it. If there is no trust, no policy will work, not stimulus, not rate cuts. Without demand, money doesn't flow. Without flow, the system stalls. That's why witness warning is so important. This isn't a sudden crash, it's a slow motion stop, and it could have long-term social consequences as well as economic ones. To sum up, 2008 was a loud pop after a debt-fueled bubble. 2025 is a silent freeze caused by broken trust. One was loud, the other is quiet, but silence can sometimes leave deeper cracks. The housing freeze isn't just about real estate, it's affecting the core of the economy: banking, bonds, and consumer spending. For banks, the issue goes far beyond falling mortgage demand. Mortgages are a major income stream and a key part of the financial liquidity cycle. But now, new mortgage applications have dropped. People aren't refinancing either. Why? Because most households already locked in low rates. They don't want to borrow again at 7%. Banks are stuck with idle capital. Profitability is falling and risk appetite is shrinking. The bond market is also struggling. The housing slowdown is hurting growth expectations. Investors are turning cautious. Normally, in slowdowns, bonds become a safe haven. But this time, it's more complicated. Everyone knows the Fed has limited room to cut rates, so bond yields aren't reacting as expected. Traditional market responses are breaking down. Consumer spending is tightly linked to housing. When people buy homes, they also spend on furniture, appliances, renovations. But now people aren't buying homes, moving, or upgrading. This is causing a ripple effect across industries, from interior designers and hardware stores to small businesses and big retailers. The psychology is also shifting. People feel uncertain, so they are avoiding big expenses. This threatens the consumption-based model of the economy. Spending slows, so does growth, employment, and tax revenue. In short, this housing freeze isn't just a sector problem. It's a system-wide risk, reaching from banking to bonds, consumption to macroeconomic balance, and it could shape the economy for years to come. To understand today's housing gridlock, we must also look at the demographics. Access to housing now depends heavily on age, income, and wealth. And here's the striking divide: young people are being left out. In recent years, most US home buyers have been over 60, debt-free, wealthy, often buying second homes. This group doesn't care about high rates. They buy with cash or trade property. But for those under 30, the picture is very different. Young people graduate with large student debt, start working low-paid, unstable jobs, struggle to save, and lose hope of owning a home. This is dangerous not just for individuals but for the entire system. Without home ownership, they can't build wealth. Without wealth, there is no social mobility. Home ownership is a key step in moving upward. It also affects family life. Marriage, starting families, and birth rates all drop when young people can't afford homes. Over time, this breaks demographic balance and destroys the idea of equal opportunity. Only the wealthy can buy. The middle and lower classes are being pushed out. This structural exclusion may lower future demand. When today's homeowners want to sell, there may be no buyers. That could lead to a long-term collapse in property values. As Whitney says, this is not just economic, it's a social crisis. A system that excludes its youth is unsustainable, and this deep divide is eroding confidence, identity, and dreams for the next generation. It's setting the stage for distrust and division across society. The Fed's dilemma: cut rates and risk inflation, hold rates and freeze the economy. The Federal Reserve now faces a major dilemma. This is more than just a central bank decision. It's a systemic impasse. The housing market is frozen, spending is slow, banks are on standby. Cutting interest rates might stimulate activity, but it could reignite inflation. So, what should the Fed do? The main reason rates haven't been cut is that inflation expectations are still above target, but the economy is clearly slowing, possibly nearing a recession. This is one of the hardest decisions a central bank can face. In theory, lower rates could help. They encourage mortgage demand, increase spending, and review the economy. But right now, that mechanism isn't working. People aren't just reacting to interest rates, they are reacting to how they feel about the future. Especially the young and middle class fear borrowing, lack income or collateral, don't believe they'll earn more in the future. So rate cuts alone won't work. People need more than cheap money, they need trust and hope. That requires structural reform, fairness, job security, and social stability. And that's beyond the Fed's control. If the Fed keeps rates high, the freeze becomes permanent. At 7%, no one wants to move or borrow. This paralyzes the entire housing cycle. Banks stop lending, construction slows, government revenues fall. The Fed's tools are limited and may no longer be enough. It needs to guide expectations, not just rates. But expectation management only works if trust still exists. And right now, that trust is broken. This crisis is not just about money, it's a crisis of confidence. If trust disappears, no policy will work, even a rate cut becomes meaningless. If this video gave you a new way to think about the economy, don't forget to like and subscribe. And we want to hear from you. Share your thoughts and your personal experience with the housing market in the comments. At the heart of economy, our mission is to cut through the noise and find the real signal underneath.